Olá a todos, sejam muito bem-vindos ao Outliers InfoMoney. Em mais um episódio da série especial que trará gigantes globais para falar sobre cenário. Me chamo Clara Sodré, sou analista de fundos na XP e nós temos aqui um episódio mais do que especial hoje, Fabiano.
Olá a todos, eu sou o Fabiano Cintra, responsável por seleção de fundos aqui na XP. Isso mesmo, Clara, dando continuidade à nossa série de episódios internacionais. Os brasileiros estão considerando cada vez mais a alocação fora do Brasil e ter um nome desse calibre ajuda a entender o que está acontecendo no mundo, né?
Exatamente. Nós teremos aqui a honra de falar com a gigante global, entender um pouco do que está acontecendo na renda fixa global, quais são as oportunidades e, principalmente, por que o investidor brasileiro deve olhar para esse tema agora.
Exatamente. Hoje temos um convidado muito especial. Teremos aqui uma parte do episódio em inglês, importação direto aqui dos Estados Unidos. E damos boas-vindas ao Jeff Mueller, que é co-head de renda fixa do Morgan Stanley, grande parceiro aqui do mercado brasileiro. Junto com o seu co-head, eles fazem gestão de bilhões de dólares em renda fixa global. E o Jeff ele é responsável pela gestão de 7 times de investimento de renda fixa para cobrir o mundo inteiro. Tá? Então, alguém que consegue elaborar sobre diferentes mercados nessa classe de ativo tão relevante nos portfólios. So, Jeff, thank you so much for joining us in this episode. Welcome to the show.
Thank you so much. I appreciate you having me.
Let me quickly introduce Jeff. He manages global credit and multi-sector strategies. Jeff Mueller is the co-head of fixed income at Morgan Stanley Investment Management. In this role, he, along with his co-head, oversees the management of 6 fixed income investment teams, focusing on the developing and expanding of the business. Jeff also serves as the co-head of high yield and is a portfolio manager on the high yield team. Jeff holds a BBA from the University of Wisconsin at Madison. So Jeff, once again, it's a huge pleasure to have you here on Outliers. Welcome to our show again.
Thank you so much. It is really great to be here. Thank you.
So Jeff, to start our conversation, Morgan Stanley is widely recognized in the global market, right? Could you start helping us to understand how the global macro scenario has unfolded across 2025 and where are we right now?
Yeah, it's a very good question, particularly given all of the challenges and all the volatility we've seen in 2025. If we go back to 11 months ago at the beginning of the year, there were many elections that were due across both the developed and the emerging world. There was a new president coming in the United States, or a new old president coming in. And then since April, we've seen a lot of volatility in markets, starting with Liberation Day and the changes around trade policy from the United States. But then also different fiscal dynamics in different countries, different monetary policy trends in different countries, and ultimately changes in valuation. So it's been an interesting year. The one thing I would say is if we look at where we are today compared to where we thought we would be if we go back to April or May, I think we're in a better place from a macro perspective. Growth has been a little bit stronger than people expected, and there are reasons why that's the case. Inflation, at least in the developed world, but also in the emerging world, has probably been a little bit more contained than people expected after some of the changes in the trade policy. Valuations are relatively compressed, at least from a spread perspective in the credit world, but all-in yields still remain relatively high. And so the demand for fixed income that is out there continues to be really strong. So when we look forward to 2026, we've actually become a little bit more positive on the macro environment. That's really because of a mix of support. Number one, from a fiscal perspective, you see fiscal support in the United States through the One Big Beautiful Bill and the tax cuts that are coming to corporates and to individuals in the United States. You also have fiscal spending that's due to come from the German government in Europe, which should provide some fiscal tailwinds for the European economy. You also have monetary policy support. We expect that the Federal Reserve will cut rates. How many times they cut, we'll have to see, but certainly another 2 or 3 times as we go into next year. That is supportive. And then also, we're in an environment where regulation is loosening, at least in the United States, where that trend of deregulation should be helpful from a growth perspective. And I'd be remiss if I didn't mention maybe the biggest theme out there that has been driving growth and that will drive growth as we go through 2026. And that is the big AI CapEx theme, which is a global theme, of course, but really heavily concentrated in the United States and somewhat in China. And we expect that that will continue to be a driver into next year. All of that being said, it's not as if there is no risk. Of course, there are still risks in the market. Valuations would be one of those risks, but also that path of growth is relatively narrow. And if for whatever reason we would see a disruption in this AI CapEx theme, that would be something that we need to keep an eye on.
So you have mentioned quite a few important things here. Let me break it down a little bit.
Sure.
Let's start with inflation, for example, and do a deep dive into inflation, right? Now in the end of 2025, we have the whole year of different measurements. Can you say that inflation is now under control after the tariffs, after this reshuffle of the global trading? Can you say that the new setup is not going to add further inflation? Can you trust that inflation is now under control?
It's a difficult question to answer, and I think the answer is not yet. We can't definitively say that's the case yet. I think, as you point out, there were plenty of concerns around inflation post-Liberation Day and the changes in trade policy. Now, some of those impacts have worked their way through financial markets, and we've seen that in some of the inflation data. But we still think there are impacts that are still to come. Also, I would say that we're in an environment, at least in the United States, where inflation is still running well above the target of the Federal Reserve. Now, the reason that's the case is because we've seen those inflationary dynamics post the pandemic that have slowly been working their way out. But now with trade policy, we're starting to see goods inflation come back into the numbers. So even though other measures of inflation may be coming down, other components of inflation, that goods inflation is rising and will continue to rise. So I think the best case scenario for the U.S. right now is that we remain relatively stable at these elevated inflation levels, around 3% as we go through the first half of 2026. But there is a downside case. That downside case is probably more driven by stronger growth than is expected. And if that were to happen, could we see consumption and inflationary pressures to the upside in the U.S.? It's possible, but we have to wait and see what happens.
We are seeing a very funny fact, right? Inflation in emerging markets are actually lower than in developed markets.
For really one of the first times ever.
Very rare, isn't it?
Incredibly rare. I mean, we saw it briefly during the pandemic, but otherwise, you look back over the course of history, almost never have emerging market inflation rates been lower than they are in developed markets. And that's absolutely a theme that we think to some extent can continue because of some of the impacts of the trade policy. It's also one of the reasons why we continue to think that emerging markets can be attractive. Countries with high real rates, inflation that's under control, central banks that do have the ability to move lower. So it continues to be an asset class that we're focused on.
So in this scenario that you just described, with high inflation now a bit more under control, how do you see monetary policy unfolding, especially in the U.S.? We saw rates going very high for a while. Situation was then under control, but the U.S. dollar strengthened quite a lot, right? And now we are kind of expecting an inflection point to adjust the monetary policy a little bit. How do we evaluate these movements in 2025? And what are you expecting for 2026?
Yeah, I think the picture in 2025 was challenging, mainly because the Fed was hoping to be on a path of decreasing rates, but because of the step change in trade policy and the concerns around inflation, the Fed obviously hasn't been able to move as aggressively as maybe the market hoped prior to April of this year. At the same time, as we talked about, inflation, while being relatively contained at this point. It's still at an elevated level. I think as we look to 2026, and we'd expect that there are at least another one or two cuts to go through 2026, and that's mainly because if you look at the path the Fed has taken, they have been relatively conservative in their cutting stance so far. We can argue over where the neutral rate is within the United States over the long term, but it certainly is lower than where we are now, and so the Fed is technically in a restrictive stance. I think for that reason, we will see the Fed cut. But if you want to get more cuts from the Fed, that will either have to come because the inflationary pictures move materially lower than where we are right now, the U.S. economy steps down materially more than where we are now, or question marks around Fed independence and fiscal dominance in the United States mean that the Fed acts more aggressively than markets expect them to. I think that's not the base case scenario for next year, but certainly a risk we have to keep an eye on.
One of the main topics of 2025 was global capital reallocation. From Morgan Stanley perspective, how is this reallocation reshaping global credit behavior in this moment?
Yeah, it's a very interesting topic because, as you point out, certainly post-Liberation Day, there was a big concern in global markets that you would see a significant capital flight out of U.S. assets into the rest of the world. I think the reality that we saw is absolutely the marginal dollar of investment has gone outside the U.S., either to emerging markets where we've seen a big rebound in investment inflows, or to European credit, for example. But we haven't seen the wholesale deallocation from the U.S. I think that's partly driven by the fact that you need to have scaled alternatives to invest in if you're a global investor in the fixed income markets. And to date, the U.S. market continues to dominate in terms of its size. I think as we look to the future, as different markets, whether they are emerging markets or whether they are developed markets outside the U.S., as they start to develop more yielding opportunities for investors to invest in, I think you will continue to see money, at least the marginal dollar, continues to go outside the U.S., even if only from a diversification theme. I think in the past, if you were invested in the U.S., you made money on your assets and you made money on the FX with the dollar strong. I think going forward into the future, there are question marks on both sides of that equation. And so I think what it means for global investors is they will continue to look to diversify outside of the United States. There will continue to be a demand for yield, and there will continue to be a demand for other risk premiums out there that maybe investors have not historically harvested, but will look to in the future.
And beyond flow reallocation, the difference in interest rate cycles globally is also evident. In your view, which regions do you think have the best risk-return trade-off in this moment?
Yeah, I mean, the first thing I would say about different interest rate regimes and the monetary policy paths is, that is not completely uncommon. I think when you look at different countries, depending on where you are in your economic cycle, where you are from a fiscal perspective, that obviously impacts where you should be from a monetary policy perspective. And so I think it's appropriate that at times you see different directions of travel or certainly different paces of travel. But for some of the reasons I mentioned before, we continue to have confidence in certain parts of the world where we believe we have support from a monetary policy perspective, a fiscal perspective, and from a regulatory perspective. I would argue again that in certain parts of the emerging markets, and Brazil would be one of those locations where real rates are high, central banks have the ability, if they wanted to bring rates lower, that there are attractive opportunities. But I also think there are other attractive fundamental opportunities in different parts of the fixed income market outside the U.S. I think credit in general, whether we're talking sovereign credit, corporate credit, securitized credit, that is a theme throughout 2025. We've seen investors allocating more and more to credit overall globally, and I think that will continue as we go into 2026.
And Jeff, there is this ongoing debate between active management and passive investment, right? And investors very often change their views. We know that Morgan Stanley is present across the globe, thousands and thousands of professionals covering different markets, different asset classes. and it has this very technical view on markets. In fixed income, do you truly believe there is space for alpha generation? And what are the strategies that you adopt as a PM to seek this above market returns in fixed income?
Yeah, I mean, I think the easiest way to answer the question is just to look at performance overall. And I absolutely believe that there's opportunities to generate alpha within fixed income because fortunately, over the course of time, a lot of our strategies and others have been able to do that. I think there's reasons for that. I think there are structural reasons for that within fixed income. Fixed income is a relatively inefficient market. You have different asset classes. You have construction of indices which overweight the most indebted countries or corporates overall, which you may not want exposure to as an investor. There are liquidity characteristics within fixed income that make it unique. And there are certain asset classes within fixed income that don't fit neatly into index composition and somewhat fall between the cracks of the index providers. And so what I think that inefficiency means is that if you have the skill set and the expertise in order to navigate those complexities in the market, then you can absolutely take advantage of those complexities to generate alpha. I think, for us as a business, we have 250 investors that are looking across the global fixed income universe. We arrange them into 6 different investment teams where we have experts looking at those parts of the market, whether it's investment grade, whether it's developed markets, emerging markets, whether it's investment grade credit, sub-investment grade credit, securitized credit, municipal bonds, trying to uncover those opportunities overall. And I think at the end of the day, where complexity of the market meets the conviction we have as investors, that's really where you find alpha. And so you can find that within fixed income.
And in this past months, we saw increased volatility in the credit market in general. And that brought a lot of noise to funds, especially in private credit funds, right? Looking ahead, still in a high interest rate environment, how do you see credit risk in general?
Yeah, it's a great question because there are opposing forces. On the one hand, you're dealing with an environment where credit spreads are relatively tight. Whatever market we look at, particularly on the corporate side, we see relatively tight spreads. Investment grades trading in a very tight spread area, high yields trading in the tightest quartile of its spreads over history as examples. So relatively tight spread. At the same time, we're in an environment where yields are still relatively high. And again, that demand profile for asset classes that have those high yields are very, very strong. At the same time, we're also dealing with credit fundamentals that are incredibly strong. If you look at the composition, for example, of the high yield market, it's one of the highest quality high yield markets we've ever had. So more double Bs, less triple Cs than we've had in history. If you look at other markets, you'll see a high quality tilt as well. When we look at fundamentals going forward, I talk about 2026 being a relatively constructive outlook. We expect that generally those credit fundamentals will hold together. But of course, when you get into environments where credit spreads are as tight as they are here, and you are in an economic environment where growth is driven by a narrow band, then of course we'd expect dispersion will increase. And I think you mentioned some of the challenging situations that have arisen in credit markets. I think we will continue to see those sorts of issues as we go through 2026. That's nothing unique to this particular cycle. In every cycle, we see credits that default where there are issues with those credits. But I think, again, to go back to your question on active or passive management, that's one of the reasons why active management is so important. If you're in an environment where dispersion is going to increase, then in a lot of cases in fixed income, your returns might be driven less by what you own in terms of credit risk, but more by what you don't own in terms of credit risk. And so I think as an active business, we need to be prepared for more of those credit events, but position portfolios appropriately.
You know that we saw something similar here in the local market in Brazil. Because in the past years, a massive inflows came into local credit.
Yes.
So as a side effect of this flows, we saw spreads very, very compressed. Up to the point that we started to wonder if those spreads would still make sense given the underlying credit risk.
Yes.
I would replicate the same question to global markets, to the US credit market. With this level of spreads, do you think that it still makes sense for investors to try to harvest yields in US credit?
Yeah, I think it is a fair question. And again, anytime you get into ranges where credit trades at these levels, you need to look with a circumspect eye. What I would say is, again, if you're able to do that in an active way and avoid those credits that may deteriorate and enter into credit stress, then you can still drive returns, mainly because, again, your starting yields are relatively elevated in a developed markets context. Investment grade around 5%, high yield around 7.5%. Those are yields that are attracting capital. It also goes back to your point where high yields bring in new capital over time, which keep those spreads relatively compressed. I think we're also seeing that dynamic not only in U.S. credit, but we see it in European credit as well. There are several parts of the world that have been invested in the high yield market for multiple decades. U.S. domestic investors have owned high yield for many, many years. But we've also seen a growth in capital, both from individual investors, but also mainly from institutions outside the U.S. who've come to the high yield asset class, for example, at some point in the last 15 years post the financial crisis. And invariably, if those investors have come to the market in the last 15 years, they've probably done it in an environment where yields are lower than they are right now. And so what we've continually seen is that any time that yields back up, there continues to be a flow of institutional money that wants to get exposure. Now, I think eventually you reach a stage where not only spreads get compressed, but yields get compressed to a level that investors no longer want to take that risk. But I think if you take that demand profile, you couple it with the fact that, as we talked about before, the quality of the market is as high as it's been, I think this is a market that can continue to offer compelling returns. But you must approach with an active lens to this market because, again, avoiding those deteriorating credits, making sure you're on the right side of that dispersion is going to be key to driving returns as we go forward.
High yield bonds are made to handle ups and downs. But when the markets face big problems, what really happens? And what can protect the investors in this case?
Yeah, you're absolutely right. I think the high yield market has been around now for almost 3 decades. So it has been through multiple market cycles. Certainly was tested in 2008, was tested again in the pandemic and at various times in between. I think structural protection is something that's incredibly important when you're lending money to anyone, frankly, whether it's a corporate or a sovereign or an individual. I think within the high yield market, it is true that we've seen a general deterioration in covenants, and those covenants are the legal protections that you have when you lend money. That's happened in both the high yield market and the leveraged loan market over time. And I think that's mainly been driven by the fact that demand for credit since the financial crisis has been higher than supply has been. I think if we look back again to most of the last 15 years, you were in an environment of financial repression where central banks had driven rates in the developed world to incredibly low levels. In order for investors to earn returns, they had to be pushing further out the risk curve to earn those returns, which drove demand. And when demand is greater than supply, then at times those lending standards can loosen. So we have seen covenants loosen to some extent in the space. I think when you do get into times of stress, Clara, you absolutely need those covenants. In good times, the structural protections are less relevant, but in bad times, they can be the difference between value destruction or the protection of value. Again, I would just echo what we've been talking about. This is really where an active approach to that part of the market is incredibly important because you want to make sure that when you take risk, whether that is structural risk or credit risk, that you are being compensated for taking that risk. And that's something that with an active approach, you can ensure you do.
Jeff, I would like to get your direct view on securitized products. From your perspective, what really matters today to understand the resilience of these markets?
Yeah, the securitized market, Clara, is a very interesting market. Clearly a market that saw a lot of stress in the financial crisis and a lot of attention post the financial crisis. I think maybe we take a step back and just discuss a securitization. In the most simplistic form, a securitization takes assets, individual assets that typically are generally illiquid, whether it's a mortgage or a particular loan, packages assets like that together and creates a tradable security. In other words, a liquid security. It also allows for the segmentation of risk into securitization so that you can sell different layers of risk to different investors in order for those investors to earn differing returns. I think what we saw post the financial crisis was a reticence from the investment community to invest in securitizations because the protections you had during the financial crisis were poor and many people lost money. I think where we are now is in a materially different place. That's a general comment, and that is mainly driven by the poor experience that people had in the financial crisis and the changes that have come to the securitized market since then. So since the financial crisis, we've now seen new regulation that means that securitization structures are much more robust. For example, there's more junior capital or equity capital that takes losses before it gets to the more senior tranches, so more subordination overall. We have seen liquidity risk that has changed over time as these markets have become bigger, more liquid, with more investors involved in them. We've certainly seen access to different credit risk premiums that give investors the opportunity to harvest those risk premiums. There's also complexity risk premiums that investors can invest in order to earn those returns. And then going back to some of the changes in the protections, you've been in an environment where there's now regulation that says the originators of these securitizations, the financial institutions that are putting these loans into these packages, have to own a slice of those securitizations as well, the skin in the game rules. So I think if you think about this market now, it is very, very different than where it was pre-crisis. There are many more protections within it. Yet, because of the complexity and the lack of familiarity, there are still attractive returns that can be earned in this space. And we think this is one of the more attractive spaces in the market.
Great. And global investors are looking more and more then for structured funds with securitization, as you mentioned. In your view, which types of structures could be the initial entry point for those coming from the local market here in Brazil and taking their very first steps into a broader investable universe?
Yeah, it's a very good question because securitized markets are very different depending on which part of the market you're in. But maybe to put some context around it, I mean, the securitized market globally is about a $13.5 trillion market. So when you think of the size of this market, it's huge. In the U.S. market, the only larger sector of fixed income is U.S. Treasuries overall. So very, very big part of the market. I think when we look at that market and giving advice to investors or views on the best port of entry, it really depends on what your tolerance for risk would be. But as an investor coming to these markets for the first time, there are lots of ways to access them in a way that we think are controlled from a risk perspective. There's a couple of places I would point out. The agency mortgage-backed securities market, for example. This is a $8 or $9 trillion market within the U.S. This is a market where you are buying securitizations of mortgages, but those mortgages are backed by the full faith and credit of the United States government. So you do not take credit risk. The risk you're taking is prepayment risk. If someone who had one of these mortgages wanted to refinance their mortgage, then there could be downside in the securities. Where we are right now in the market, with mortgage rates continuing to be high in the U.S. and the average rate on an outstanding mortgage being as low as the low 4%, we think that prepayment risk is very, very low right now, and you earn a premium over investment grade credit. So if you're coming to this market for the first time, you want to dip a toe in and become more comfortable, that is a part of the market that we think is very attractive. And in a number of our strategies, we are materially overweight that part of the market. But it's not the only high quality part of the market to look at. We also like the non-agency residential mortgage market in the U.S. So this is where you are taking credit risk, but you're taking credit risk on a U.S. homeowner base that has seen the value of its homes go up by 50% since the pandemic. In other words, there's a massive amount of equity that is sitting in these structures. And so the reduction in home prices and the losses that you would have to see to actually have your credit impaired would be very, very high and not something we foresee in the future. Again, very attractive yields compared to investment grade within these asset classes. You can also go a little bit further down the risk curve, and instead of buying the investment grade tranches of those securitizations, you could go into the sub-investment grade tranches. I would also point out the CLO market as well. CLOs, collateralized loan obligations. The collateral pool for those securitizations are loans themselves, floating rate loans that are generally syndicated out to buyers. That is a market that we also think is very, very attractive. AAA CLO tranches, which are yielding similar to all-in yields for investment grade, which obviously has a lower average rating. That is a market as well that we think is interesting for first-time buyers into the securitized space.
Before we start in a new year, what's the opportunities that you see for 2026?
I think given the market environment right now, Clara, we see a lot of opportunities for 2026. I think in order to capture those opportunities, investors need to think about diversification. They need to think about earning returns, in other words, harvesting different risk premiums. And in order to do that, you really need an active approach overall. When we look at the market, we think opportunistic strategies are quite interesting, whether that be in the emerging market space, which we continue to think has value in different parts of the emerging market world and will provide attractive return opportunities as we go through 2026. The securitized space, which we spoke about a bit about here, having an opportunistic approach and a flexible approach that can move across the different sectors in securitized is an area that we think will continue to bear fruit in 2026 because, again, you can harvest different risk premiums in that space, whether it's complexity, liquidity, credit, rate risk. And then I think there continues to be opportunities to get returns into portfolios by focusing on those asset classes that are offering attractive risk-adjusted yields. And we still believe that credit can do that, and particularly sub-investment grade credit. As we talked about before, it doesn't mean that there might not be some level of credit deterioration in the market, which is normal for any credit cycle when you go through that. But again, having an active approach, a risk-aware approach, and positioning in the higher quality parts of those markets can continue to drive returns in 2026. So flexibility, diversification, and active are key.
Never in the history of the investment management industry in Brazil was so easy to open a global account and to invest in international funds, for example. Very easy. What message, what a piece of advice would you give to Brazilians who still don't have any investment abroad?
Yeah, I think going back to the diversification theme, that's something that I think is very important. And I think all of us tend to have a domestic focus when looking at markets. And I think one of the luxuries of being in the position that I'm in at the firm I'm at and being surrounded by such talented investors is we really do have a global perspective. And I think the wider you can open your investable universe, the more opportunity you have to find those opportunities, not just in your own backyard, but around the world, to harvest that risk premium, do it in a risk-controlled way, and get better returns into your portfolio while balancing risk overall. So to me, given everything that's going on in the world, given everything that's going on here in Brazil as well, it's an incredibly interesting time to open the aperture a little bit wider and look at the opportunities that are out there.
Before we finish, we have a special segment
where
we talk about your personal perspective and career lessons. It's called Beyond Investment Management. Jeff, any book or podcast in this moment? Any recommendation?
Very interesting question. Well, right now I'm reading a book called The Inner Game of Tennis. Now, I am not really a tennis player, certainly not to any high standard whatsoever, but a friend of mine recommended it. I'm not finished with it yet, but the book is very interesting. Of course, it focuses on tennis, but really it is a book that teaches lessons about life, about business in general. I think the thread that runs through this book really focuses on understanding that there's a lot of noise in each of our lives. There's a lot of inner doubt self-pity that all of us sometimes find ourselves in. But in order to perform, whether it is in a sporting arena, whether it's in a business arena, or frankly, whether it's in your own personal lives, it really depends on, are you able to reduce that noise, analytically focus on how things are, and let your own potential really shine through. And there's an equation in the book that said performance equals potential minus the noise. So all of us have inner potential within us. Really what our performance amounts to is how much can we balance, push out, ignore the noise, and focus on actually what is in front of us. So really interesting book, even if you're not a tennis fan. It's also an incredibly short book, an easy read overall. So I would recommend it even if you're not a tennis fan.
Jeff, thank you so much for participating here on our episode. Thank you for your contribution, for Morgan Stanley's contribution to this journey for Brazilians to invest more and more abroad. We believe that there's still a gap in the local industry. Brazilians should invest more in non-correlated risk factors in order to improve their risk-return ratio in portfolios. So thank you for your contribution today.
I really appreciate the opportunity to be here. Thank you so much.
Jeff, thank you so much for your participation. E você que está nos acompanhando, queria deixar o nosso super obrigada. Lembrando que teremos uma versão com tradução desse episódio. O Outliers ele nasceu para trazer essa democratização de informação como um todo. E a gente está muito feliz em compartilhar um pouco do que os grandes investidores estão enxergando nesse momento de mercado. Nosso episódio fica por aqui, mas lembrando, semanalmente, continuaremos publicando nesse final de ano todos os episódios. Continuem nos acompanhando por aqui e principalmente compartilhando esse conteúdo. Obrigada a todos e até uma próxima.